Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started.
Welcome to episode number 21. I'm coming to you live from Kaneohe, Oahu, one of my favorite places on earth. Today's episode is why enterprise value is built during growth, not at exit. Exit is a transition and not a transformation. If you wait until you're ready to sell to fix the business, buyers will see it as an unfinished product and price it like a turnaround, not an asset. This leaves you holding the bag and not getting all the money that you can on your exit, which, by the way, is a problem. What you're going to find is enterprise value is the compound result of hundreds of growth decisions. This is done over time. It's not done instantly in a weekend. These are good decisions that you've made, whether it comes to operation, whether it comes to accounting, sales, whether it comes to the type of people that you hire. When you take a look at this and you map out the process, what you're going to find is the actions you take 5, 4, 3, 2 years in advance really compound and work toward your benefit. It's tough for me when people will call and say, "Hey, Scott, I want to sell my company and I've got a 6-month horizon." Like, it can be done. You're not going to get the max multiple. It could be done and you're going to leave a lot of money on the table. And here's the sad thing. If you leave the money on the table, the private equity company, the investor, the investment group is going to come in and they're going to fix whatever you decided to not change, and they're going to benefit from it. Probably within 6, 12, or 18 months, they're going to have major upside. And so my belief is you should get as much money as you can on your exit, because the company, the individual, the group that's buying you, they're going to make the money. You want to have value embedded over time. And let me give you an example. You can have 2 companies with the same revenue sell for radically different prices, depending upon the results that are repeatable without the founder. So the question that you really could be asking is, hey, look, if I disappear for 30 to 60 days, what breaks first? And if that's too far out of reach, start with 1 week. If you can only be gone for 1 week, it's a sign from the business gods. It's a sign from the business gods that you need systems and processes in place. And then once you get the 1 week mark, then you leave for 2 weeks. And then once you get the 2 week mark, then you leave for 3 weeks. And then you go for 4. When an investor, when private equity, whatever you want to name them, comes in, one of the questions they ask you in the interview process is, how long can you leave for? How long can you step away from the business? How much time can you be away? And is your management trained? At some point, this conversation is going to come up, so you might as well prepare for it. Hey, what kind of team do we have? How deep is our bench? What happens if somebody leaves? What happens if somebody decides to move? What happens if somebody passes away? These are all legitimate questions that you could be asking. You want to treat the de-risking of your company and your organization like a habit, not like a pre-exit project. Because here's what may happen. You may go 5, 4, 3, 2 years into your process and decide to say, hey, look, I really like this company. I'm not going to sell it. And if you're on the path of just like, this is a pre-exit project, you have a risk where it doesn't feel real and you're not going to get it done. This should be done for growth. One of the things that you can do is you can go to your team, and this is a good exercise, by the way, and you ask them, hey, what are the 3 biggest risks that we have per department? What are the biggest problems that we're facing? What do you see on the horizon? And one of the mistakes that I see founders and business owners make a lot is they discount the advice that's giving them from somebody that's on the front line. And it could be that it's a way that you make your decision. It could be somebody on the team that isn't pulling their weight. You know, Jack Welch used to say, if you're in a rowboat with 10 people, you know who's not rowing. And I will share with you, sometimes as an outside consultant, I see managers get frustrated. I see frontline people get frustrated when I come in and I have a conversation and I say, hey, listen, here is an opportunity. And the team has been screaming it from the rafters for months on end, sometimes even years. A couple of ways that you could make your process easier just from the very beginning comes from documentation. Today, there's AI apps that'll help you do this. If you don't want to use an AI app, you can absolutely go old school and go 3x5 index cards and paper or whiteboards. Whatever you decide to do, that documentation needs to be there with cadence. That means that every 3 months you're checking and making sure that that documentation is correct. You want dashboards, you want training, and you want accountability. You want all these things not to be like a topic of the week, that it just happens automatically. And each one of these items that you implement lowers perceived risk. And those small reductions turn into multiple expansions. They work to your favor. This means you want systems, clear rules, KPI ownership, and decision rights to create operational consistency. And let's just go through this. Systems and processes are some of the boring things in business, but once you put them in place and you take the time, they're guardrails. They're guardrails for you to make sure that things are being done right. Clear roles. From an employee standpoint, employees, they're looking up the mountain and they're saying at the very top is ownership and in the middle is management. And what will happen is owner will make a decision and throw a ball down the mountain. It gains speed. It gets to management. Management changes it. It gains more speed, and then it ends up at the very bottom with all the employees. And that feeling of who am I supposed to answer to, and who is the person that is really my supervisor, my manager, the executive that I go to. You want to be able to have a consistent message for the employees that are inside of the team to know, who do I go to? What is my rank? You know, is the person above me a lieutenant? Are they a general? How do we make this work? You want the mantra that we're running a business, not rescuing a business. And there is a huge distinction here, and it really does matter, because a lot of times when consultants are called in, when somebody's called in for help, it is possibly a business that's in flatline, meaning that there's zero growth. It is possibly that it's resurrection. And there are times where it's amazing to walk in and the team is like, hey, we need help because we see that we're stuck and we have a ceiling of complexity, or we have an area of complexity that we can't break through, and we need some help here.
A message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going.
Going inside of a company and taking a look at a culture is something that's very important. And you will find that private equity, private investors are going to go in and they're going to say, hey, tell me about your team. Tell me who on the team that you think is a good fit. Tell me on the team who you think is going to leave. Tell me on the team who somebody that is looked up to. And this is an important feature. You know, culture isn't vibes. It's a consistency of execution when pressure hits. And if you have a team that only works well under pressure, or there's one or two heroes that solve all the problems, buyers are going to see a fragile purchase and they're going to discount accordingly. If performance depends upon habits, buyers see stability, and that's what they want. They're buying the history and making sure that you're executing the correct way. Another way of looking at what you're putting together is evidence accumulation. The buyers, the investors, private equity, they value the trends and tracking records more than forecast and story. Forecast is cool. It's where we're hoping to go. We're hoping to go to the moon. But the roadmap of what you've done in the past, it really matters. And so if you have KPIs and you have dashboards and you can have proof, my favorite thing is to have 3 years of proof, 3 years of running proof that there's operational exceptional operation, excuse me, and that the company is growing. And if you're going to an investor, you're going to private equity, it is entirely possible for you to ask for more at the exit by saying, "Hey, look, I've got proof. We're on the growing trend. We're not on the decline. We're not flatlined. We're not on the decline. We're on, and the average in the industry is 10%. We're at 20. So you want to bring a proof library to the table, and that's standard operating procedures. It's dashboard, it's meeting rhythm and cadence, it's quarterly review decks, it's churn and cohort reports, it's hiring scorecards. These are all of the items that really make the company pop when it comes to getting the maximum multiple. When you go to sell, you want a buyer's frenzy. And optionality really creates that for you. The more transferable your company, your organization, your office is, the more buyers that you're going to have saying, I want to buy this company, I want to invest. You end up with all the leverage. You don't want to just sell to somebody. You want to sell to the right company, to the right organization, and be purchasable or buyable at any time. So that when it comes down to it and you're like, you know what, it's time for me to check out. I'm gonna go hang out on the beach. I'm gonna not ever wear shoes again. There are windows of time depending upon the way that the market is going. It depends upon what major investors are doing. It depends upon where the belief in the market is. And in this window, there's times where you have maximum multiple, and then there's some times where you have a depressed multiple. And you want to be ready for the time when the opportunity hits for you to say, this is the time that I'm going to jump in, and that this is the opportunity for me to sell my business. What you don't want is to have to take what you get that's in the marketplace. And sometimes that happens with sellers that they get fed up. They don't have the systems, the operations in place, and they're constantly trying to fix stuff. It's always the heroics. It's the fragility of the company, and they get burned out, and we'll just take whatever offer there is. And the sad thing about that, once again, is when you choose to take that path, then what happens is whoever's coming in to take over the company is going to put those items in place anyway, and they're going to benefit from what you didn't do. Mistakes that owners, founders, and even executives make is they treat growth as it's only sales and marketing. And buyers, they count growth quality. This means durability. It means margins. It means concentration risk. It means leadership. It means depth of the bench, not just speed, not just revenue. Because when you take a look at a business, you can make those numbers look really good. But when you pull back behind the scenes, it's chaos. It is not a good position for you to be in. For you as an owner and founder, you have to move away from owner dependency. This means all the approval bottlenecks, the founder relationships where you know the person who's going to solve the problem or only gives you the deal, pricing exceptions that only come from you. At some point, you have to move away, and that's got to go to an operator. That's got to go to a manager, because every dependency is a ding or a dent when it comes to an earnout, a holdback, or a flat out haircut when it comes to what you're going to be willing to be given as a price. I'm going to give you 3 frameworks to run everything through from here on out. Framework question number 1 is, does it reduce risk? Anything that you're doing should reduce the risk of your organization. Number 2, does it increase transferability? Does it make it easy for somebody else to come in and take over the company, the organization, the practice? And then third is, does it create proof that a buyer can verify? What is your history? The company that's coming in, the investor that's coming in, is they're buying your history. And you want to be able to prove that story. You want facts. You want documentation. You want SOPs. You want org charts. You want all the things that takes time to implement, but those are the things that you're going to get the maximum multiple for. So your role and responsibility this week is to pick one growth initiative and rewrite it. Look as if you were coming in and invest in the company. And ask the question, Does this move make the business more independent or dependent, or is it just busy work?
Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test, all free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.